Today we are covering the critical statutes of limitations for tax assessment and collection. The exam will test you on specific timelines the IRS must follow, and knowing them is essential for correctly answering several questions. The general rule is that the IRS has 3 years to assess additional tax. This 3-year period, known as the Assessment Statute Expiration Date or ASED, starts from the date the tax return was filed. However, a key exam trap involves early filing. If a taxpayer files their return on March 1st, but the due date is April 15th, the 3-year clock does not start until April 15th. The rule is always the later of the due date or the actual filing date. Conversely, if a taxpayer files late on June 1st, the clock starts from June 1st. But this 3-year rule has major exceptions. The most frequently tested exception is the substantial understatement of income. If a taxpayer omits more than 25% of the gross income that should have been reported on the return, the statute of limitations extends to 6 years. For example, a client reports $80,000 in gross income but failed to include a $30,000 payment for a consulting project. To see if the 6-year statute applies, you must calculate 25% of the reported gross income, which is $20,000. Since the omitted $30,000 is greater than $20,000, the IRS now has 6 years to assess additional tax, not 3. The exam will give you specific numbers and expect you to perform this exact calculation, so be careful to base it on reported gross income, not adjusted gross income or taxable income. There are also situations where the statute of limitations never expires. If a taxpayer fails to file a return at all, the clock never starts, and the IRS can assess tax at any time in the future once the delinquency is discovered. Similarly, if a taxpayer files a fraudulent return, there is no time limit for assessment. The exam might present a scenario where a taxpayer intentionally omits income or claims fictitious dependents, which constitutes fraud, making the statute of limitations indefinite. Now, it is crucial not to confuse the assessment statute with the collection statute. These are 2 separate and distinct clocks. Once the IRS properly assesses a tax liability, a new clock starts for collection. The IRS generally has 10 years from the date of the assessment to collect the tax. This is known as the Collection Statute Expiration Date, or CSED. For instance, if a tax return is audited and an assessment is made on November 1, 2023, the IRS has until October 31, 2033 to collect that debt through actions like liens and levies. The exam will try to trick you by referencing the tax return filing date in a question about collection. Always remember the 10-year collection period starts from the date of assessment. A simple way to keep these timelines straight is the phrase 3, 6, 10, infinity. 3 years is the general rule for assessment, 6 years for substantial income omission, 10 years for collection after assessment, and infinity for fraud or failure to file. This mental shortcut helps you quickly categorize the scenario presented in an exam question and apply the correct time limit, avoiding the common traps of confusing assessment with collection or miscalculating the start dates.